All right, traders, in this session today, I am going to show you and teach you how to trade one of the strongest signals in Ichimoku, three-row reversal, three-row improvement. I'm going to teach you how to trade that, but I'm going to add something to it to help you have a better winning percentage, a better probability for your trade to work for you, which would be adding the time theory, the price theory, and the wave theory to the trade to help you to determine where those targets are, when you should get into the trade, if you should get into the trade, and so forth. So I'm going to add the three theories in there to help you to understand how to trade this better. So therefore, you might have a good opportunity at having some very good trades. So I'm going to teach you how to do that coming up right now. So stay tuned. All right, my friends, before I get started, I'd like to give you a word of encouragement, which comes from Psalms 46:1, and it states that God is our refuge and strength, an ever-present help in trouble. This is a strong biblical passage that reminds us that even in the face of trouble, God is our refuge and our strength. God promises his presence in trying times. We can always depend on God's presence when tragedy strikes. A quote from writings on the wall inside the Auschwitz concentration camp, which said, "I believe in the sun even when it is not shining. I believe in love even when I am alone. And I believe in God even when he is silent." In the midst of tragic circumstances, God is still present, even when it is hard to see or perceive. Psalms 46:10 states, "Be still and know that I am God." This command, "be still," is written in the context of time of trouble and war. The reality is there is going to be difficult times in your life, but God promises to be your refuge. During every trial and tribulation, God has not failed you. He has promised to be with us in the middle of tragedy. We sometimes think that when we find ourselves in difficult circumstances, that God has abandoned us. But that is not the case. Be still and know that he is still God, our refuge and strength, and ever-present help in trouble. God bless. All right, traders, so I'm ready to get this session started. Got a lot of information I want to give to you today. I'm going to really show you and teach you how to trade the one of the most strongest signals in Ichimoku, which is your three rows improvement and reversal strategy. Basically, it's a basic strategy that you probably know, but you probably get stopped out a lot or don't know how to really trade this strategy. So what I'm going to do is show you how to trade this strategy and help you to be more proficient with it, because what I'm going to do now, I'm going to teach you the strongest strategy that you can use with Ichimoku, and then I'm going to show you and teach you some of the three theories, and then we're going to put that together, and that's going to help you to have a more valid, more high probability trade when you do take the three-row reversal. All right, so you're not just looking at the signals, you're also understanding the market structure, because what happens basically is these theories help you to understand the market structure also. So let's get right into this and start to jump in this. And I'm going to be taking myself in and out of the screen here because I know I'm in your way at certain points, so you won't see me down here all the time. But to start with, the three-row improvement and reversal strategy is the strongest Ichimoku trading strategy that you can learn. Ichimoku equilibrium is composed of market prices represented by your candlesticks and 5 lines. Using these 5 lines, we will search for trading points. Among them is the 3 rows improvement, known as a strong buy signal, and the 3 rows reversal, known as a strong sell signal. As the term three rolls indicates, there are three conditions that must be met. It is the most basic buying and selling signal used with Ichimoku by judging mainly from the cross of the Tenkan Kijinsen. So for the more experienced trader, adding the wave, price, and time theories will greatly increase your chances of a successful trade. The wave theory will help you to determine the direction of the market. The time theory will help you to determine when to expect the market high or low. And the price theory will help you to determine a target level when taking your trade. All right. So basically, guys, I'm going to show you also these three theories, and we're going to get into those. But if you want to learn more about what I'm talking here today and understand more and be with me for a while to learn this stuff, you can become a lifetime member right now. Just visit my site, visit this link, go to my site and become a member. You can become a lifetime member, learn these theories even more, and also learn how to trade Ichimoku more, learn about fractals, learn about support and resistance, so forth. So I'll help you to become a better trader, and using Ichimoku and these strategies will help you to become a more disciplined trader, a more patient trader. You'll know what you're looking for and waiting for. All right, so you'll learn Ichimoku and understand how to be a better trader in doing so. All right, so let's continue. So the three rows improvement buy signal, which would be rule number one, which is going to be your Tenkan conversion line breaks above your Kijinsen, your reference line, and that will be called balance improvement. When Chiku span, your lagging line breaks above the price line, your candlesticks, that'll be rule number two. The current candle breaks above the cloud will be rule number three. Then we enter the market at that point. When that candle breaks above the cloud and closes, we enter the market. The point is to achieve the conditions in the order of 1, 2, and 3. It's possible to see the order of 1 and 2 change, but the third rule should never be before the first two rule. It should be the very last rule to take place. But if rule 3 takes place before either of these rules, 1 or 2, the signal is not valid and should be ignored. Okay, so let's look at some of these charts. So basically you're looking here and you see that you have your crossover here. You have a TK crossover, which is a bullish crossover. So we're going to be looking for a buy signal. We're going to be looking for the market to break above the cloud, because now you got that crossover, which is signifying a possible change of direction, possible trend change. Not always, as you can see back here, it happened, but that's what we're going to be looking for if the market moves higher. And then you got number 2, which is your Chiku span above the price level here, your price candle, your price line. Chiku span closed above the price line. So you have rule 1 and 2. And now you have rule 3, where the price closed above your Kumo right here. Closed above your Kumo right there. These did not close above your Kumo. You should not have taken these. This closed above your Kumo. And then you enter the market at that point. That's trade. That's rule number 3. You're in the market. And boom, 303 pips you make. All right, just that simple, right? Well, no, not necessarily. So I'm just showing you basically how this basic trade just took place and how you can catch that trade. Now, getting out of the trade will be the thing, and we'll talk about that in a little bit. All right, so let's look at your 3-row reversal sell signal. So that sell signal will be your Tenkan-sen or your conversion line breaking below the Kijinsen, your reference line, or your balance. That will be called your balance improvement. All right. And when Chiku span, your lagging line breaks below the price line, your candlesticks, that's rule number 2. And then rule number 3, the current candle breaks below the cloud. You enter the trade when it breaks and closes below the cloud. Again, these points are to be achieved in the order of 1, 2, or 3. And again, you don't want to see rule number 3 happening before rule number 1 and 2. If it does, it's not valid. All right. 1 and 2 can switch, but 3 has to always be 3. Impatient traders or traders who want to break rules will not follow this, most definitely. All right, so let's look at this bearish opportunity. We have a TK cross over here. All right, so a death cross. And then we have Chiku span closing below price. All right, below the price candle level. And then we have the market closing below your Kumo cloud. So your candle closed below your cloud, you enter the market right there. Again, I place my stop loss at this Kijinsen or the fractal. Big stop loss, but you got to allow for the market fluctuation. If you can't take that trade, don't take the trade. All right. Now, since you're trading below the cloud, this cloud is a resistance band. So therefore, you can also use the cloud levels as support and resistance and basically use that as a stop loss level also. All right. But if you're going to use the cloud level, you want to be in the middle of the cloud, because when price comes up, more than likely the lower level of the cloud will hold resistance for you. And then that way you can have your stop loss in the middle of the cloud and the price may not come back to that point. Okay. And then finally, look what happens. The market continues to move lower and then it closes above Kijinsen right here for the very first time. When it closes above Kijinsen, you're out of the trade. And if you waited that far and that long and you were able to withstand some little corrections here, then you made 571 pip profit on one trade. All right, so very good trade opportunity there. So now let's get into the wave theory. Let's get into the Ichimoku theories, and we're going to start off with the wave theory. The wave theory shows the idea of three basic waves. Those three basic waves are the I wave, V wave, and N wave. The I wave is a movement that only moves up or down. V waves are moves up and down, or from down to up. All right. So basically, a V waves move from down to up or from up to down. All right. In a bullish market, the N wave is a movement that moves up, down, and then up again. And the upward movement is the impulse wave. The downward movement is the correction. In a bearish market, the N wave is a movement that moves up, that moves down, up, and then down again. That downward movement is an impulse movement, while the upward move is a correction. The combination of I wave and V waves equals an N wave. All right, so on your chart, on your screen now, you should be seeing a bullish I wave right here and a bearish I wave. That's your one wave formation. And in the market, here's what it looks like. A bullish I wave from the very extreme low to the next extreme high. That's your I wave, bullish. Here's your bearish I wave from the extreme high to the extreme low. All right. And then here's your V wave. This is a bullish V wave. This is a bearish V wave. V wave looks like an upside down V, and this looks like a regular V that's got chopped off. Okay? And seeing that in the market, you would see a bullish V wave where it went up and then down. Again, this is your impulse leg, your corrective leg. In a bearish market, your impulse leg and your corrective leg, you could see this V wave formation. Okay? And then finally your N wave. Back to your V wave. This is a two wave formation. In the market structure, we're looking for a three wave formation at all times. We're always looking for that three wave formation to finalize the movement, which would then be this N wave. This is a bullish N wave. And this is a bearish N wave. In the market, it looks just like this. Move higher for the impulse, correct, and then higher on another impulse. This allows me to know that the market's continuing to the upside, all right, and there's no change of direction at this point. So if you've been trading the 1, 2, 3 formation or the AB equals CD formation, you've been trading Ichimoku wave analysis, wave theory. You've been trading that without knowing it. All right. So when I'm always talking to my students in sessions, I'm really always talking 1, 2, 3. I want them to understand that 1, 2, 3 formation, because that's the basic formation of the market, and you're going to see that formation all the time. And then that's what's going to help you to understand the direction of the market also. Okay, so here we had a bullish N wave, and here we have a bearish N wave. All right, impulse, correct, impulse. Lets me know the market's continuing to the downside. Then we have P waves, which are basically 5-wave formations. Basically, these are intermediate waves. So you have your 3-wave formations, and then you have intermediate waves. These waves are fluctuations, all right, but they are still continuation patterns of the N wave, and I'll try to show that to you a little later. But basically, this is what you're going to see in the market, and it looks much like this. As you can see, that was a P wave in the market. What you're seeing is this leg and then this P right here. That's a P with your stick. Okay? And then you have a bearish P wave. A lot of times these P waves are continuations. So going back to this one, you would see it move to this point, drop to this point, and then move higher. In that space, you would still have an N wave because you would see the market go higher to the low point and then higher. All right, and then you would still have that N wave formation. A lot of times they break to the upside, but the continuation side, but not always. So they can break either the upside or the downside. And then here's your bearish P wave. It's usually going to continue back to the downside after breaking formation, but not always. All right, so it can either break either way. Okay. And here's a bearish formation. Here's a bearish P wave. And then the market went to the upside, not to the downside. And then here's a Y wave. The Y wave is not seen much on the charts. I don't see a lot of Y waves. All right, I see mostly P waves. And here's a Y wave, not a very clean Y wave, but you could see the market was making lower lows and higher highs slightly, and then finally broke out of that level, okay, and then moved higher. And then here's a bearish Y wave, continues to the downside, but could break to the upside, okay. And then here you see that to the downside, Y wave breaks to the upside, not to the downside. So it's not going to be that continuation all the time. It can be either or. So watch out for that in the markets. And then you have an S wave. I trade this S wave exclusively. All right. A lot of times people don't know what I'm trading, but when I say I'm trading a fractal bounce, they don't realize that that's just an S wave. It's the wave of the market, and it's just a natural structure because these markets are fractal in nature, and I'm always trading this S wave. Even without Ichimoku, I just trade an S wave formation, a structural formation of this S wave, and you can trade that all the time, and you'll see on the charts. Now here's the S wave. This is a bigger S wave where the market made this S wave formation, came back to this level right here, and this is where I want to get into the market. But on a smaller scale, here's a smaller S wave. Down, up, and then down. Look where it came back to. Right back to this level where it started. Down, up, and then down. And then I get into the trade here. So that's how I'm trading S waves mostly all the time. And here's a bearish S wave. The market will continue back to the downside after finding this level here and then dropping to the downside. All right. And here you see it in the market. S wave, bigger S wave, drops to the downside, comes right back to the level where it started, and then drops. And eventually the market does break this level and continues to the upside. This is a good sign. It shows me we have an N wave here now, and it continued as it broke this level and moved to the upper point and made a clean N wave. Now I know the market structure has changed from bearish to bullish. All right. Let's talk about the Ichimoku Kinko Hyo price observation theory. Price range observation theory is based on the past price range and forecasts future high and low prices. It is a method for predicting the price range when the market price rises and the market price when the market price fails. All right. The price range observation theory is a theory for calculating target values, and there are four typical target values, the four basic target values. There's other values, but we're not going to get deeper into them because these are the basic ones that really matter the most. You have E1, E2, but so forth. Let me explain these values, which would be your V calculated value, your N calculated value, your E calculated value, and your NT calculated value. As I said again, there are other levels, E1, E2, and so forth, and then half values. But let's not get deeper into that. If you maintain with these levels here, these values, you'll be doing just fine. So looking at those levels, why do we even need the price observation theory? Basically because the market moves in these N waves, number one. And then the second thing is, when you're taking a trade, you should be taking the trade in the direction of the strength of the market. So that means after the correction, so after leg 2, after the V formation, you should be getting in at the C level or the 3 level, because I go 1, 2, 3, and I'm shooting for 4, or A, B, C, shooting for D. That D would be the E target, and that's where you're going to see it right there. And how you find it is B plus B minus A equals E. So what you do is you take this B and you minus B and A. So if this from A to B is 100 pips, you just take that 100 pips, add it on top of B right here. And 100 pips higher will bring you to this point. That'll be target E. That'll be your one target. And you're going to be looking at 4 targets. So that's 1. You'll put all 4 on your chart because you're going to get in the trade in this area. And now you're going to know where to go. Then you have a V target, which again is going to be B plus B minus C equals V. So this time you're not taking this leg, you're taking this BC leg. Let's say this BC leg here is 75 pips. Now you're going to take that 75 pips and add it on to the B again. Before you added AB onto B, now you're adding BC onto B, and that'll give you V. That'll be your second target you're shooting for. All 4 targets should be listed before you get into the trade. So right now we have 2 listed. Let's go find our other targets. Now you're looking for your N target. This target, guys, is one that you probably know about but don't even know you know about it. Right? So what it is basically this N target is a 1-to-1 measured move. So it's a 1-to-1 move. You know that in Forex or trading the market, you ever heard of a measured move? If you know a measured move, you know the N target, because all that is AB equals CD. That's what it is. Or 1, 2 equals 3, 4. So what happens here is you get C plus B minus A. All that is taking this B minus A. Let's say B minus A is 100 pips. Again, now you take that 100 pips and add it on to C. Add it on to C, gives you this N target. So now you have 3 levels that you've already shooting for when you get into your trade in this area. All right, and you have a measured move. This is going to be the most sought after target you're going to be looking for. Okay, easy to understand. And then finally you have your NT target. This one doesn't move that far sometime, but basically what it is this C plus C minus A equals NT, your final target. All right, so what you're going to do is take C and minus it from A. So you're going to take C here and drop down to A. Let's say it's from here to here is 60 pips or whatever it may be. Let's say it's 75, drops down to here. Then what you're going to do is take 75 or however much it is from C to A, add it on to C, boom, gives you your target NT, your last target that you're going to be shooting for. And that's what you're going to look for in the market. All right. So let's continue. Now, some of this stuff you may not need at this point, but I'm going to explain a little bit more to you. Okay. So Ichimoku Kinko Hyo time theory. The time theory is the most important element of the three theories. Ichimoku Yamato believed that the number of days when the market price rose and fell tended to be limited by basic numerical values. Gann theory, much like Ichimoku time theory, also states that price is the most important element and time always balances the market. Sorry, it doesn't state that price is the most important element, that time is the most important element. All right, and time always balances out the market. Ichimoku has a few major tools when considering time period cycles. Those tools are Kian-Suchi, which are the basic numerical values, Tadosochi, which is the equality in numerical values, and then Hinka-B, which is the day of change in the market, change of direction, acceleration, or extension of the market. In the wave theory, we use Hinka-B to analyze the projected day at which the market might change direction, accelerate at a faster pace, or continuation where the bullish or bearish move continues. So the Kian-Suchi numerical values are as follows. So Ichimoku uses these basic numerical values to trade with, to use in the market. It's going to be 9, 17, 26, 33, 42, 51, 65, 76, 83, 97, 101, 151, 126. These numerical values you're going to be looking for Hinka-B. Hinka-B is going to be the projected day that the market changes or accelerates or there's a change in the market. So a lot of times it will be, maybe that's going to be the high and the market drops. Maybe that's the low, the market moves higher. Or maybe that's a point where the market was a little bit stale and then all of a sudden it took off, went higher, took off, dropped much lower. That's going to be the change day, one of these days. And we'll talk more about that. All numbers are based on 9, 17, and 26. Therefore, these are the basic numerical values. These basic numbers are also involved in the calculation of the Ichimoku 5 lines. In addition to the basic values, the Ichimoku Kinko Hyo also has a concept called equal values or compound values. The equal value or compound value is the idea that the past cycle is repeated at intervals that are not bound by the basic values. We subtract numbers with the compound numbers when we are using them due to using the number twice when at a high or low starting point. So you'll see what I'm talking about when we talk about subtracting numbers. So basically, here's your numbers, 9, 17, 26, 33, and so forth down the line. Those numbers, the basic numbers are 9, 17, and 26. The compound numbers are everything below that. The basic numbers, 9, then you get 17 equals 9 times 2 minus 1. 26 equals 17 plus 9. 33 equals 17 times 2 minus 1. We use the number twice. We subtract 1. 42 equals 17 plus 26 minus 1. 51 equals 26 times 2 minus 1. 65 equals 33 times 2 minus 1. 76 equals 26 times 3 minus 2. 83 equals 42 times 2 minus 1. 97 equals 33 times 3 minus 2. 101 equals 51 times 2 minus 1. 151 equals 51 times 3 minus 2. 226 equals 76 times 3 minus 2. All right? So, we talk now about Tadosochi. Tadosochi is the equality in numbers. Tadosochi is affected by Kihan-Sochi. All right? Using Tadosochi, we analyze the market to see if the same numerical values appear repeatedly and consecutively. So in the chart below, we can see Tadosochi 43 and 42. The numbers 43 and 42 are Kian-Suchi, and they occur on the day of change, which is Hinka-B. So the day of change is this low. You had a low here at point A, and then the market accelerated to the upside. It moved from downward to upward. That's Hinka-B. So then the market moved to this low, and the next day moved higher. That's a change day, Hinka-B. So from A to B, from this low to this low, was 43 bars. Well, from that same low to another low, which was a change day because the market came down slightly and then went higher, started moving higher. That's Hinka B here. Hinka B here, Hinka B here, Hinka B here. Hinka B is almost really at every fractal point, all right, because that's where a change in the market took place. And then you're counting those numbers between those points. So that drop here to this point was 42 bars. This was 43 bars. Our Ichimoku number, Kiansuchi, is 42. Give or take 1 or 2 days, puts us right on line. So we're allowed to be, if it's 42, we can be 40 or 44. We're 43 and 42 right on the nose. Here again, you can see points A, B, C. Kiansuchi, 18. Kiansuchi, 19. All right, Hinka B. Hinka B, Hinka B. Day of change, day of change, day of change. A and B are the same as B and C. Give or take 1 day. This was 18, this was 19. All right, Kiansuchi is 17. 19 were allowed, 18 were allowed. So you could see equality before a change day. So that helps you to know when you're trading and you're looking at equal numbers, equal numerical values, you know that a change day may happen on day 19 if you're using daily candles here. All right, you'll know that on the 19th day, you may see the market now, since it dropped, it may start back to the upside again, which I'm trading, I'm going to be trading this S wave pattern, as you could see right here. This is an S wave, which would be 1, 2, 3, and then 4. We just have an S wave here. It comes back to this point. I'm getting into the market here. So if I know this is 19 bars, I'm expecting acceleration to the upside because we just had to drop to the downside. And I'm expecting 19 bar acceleration because we had a previous 18 bar acceleration. The market moves higher. Okay, a little bit complicated, but not too complicated because it can get much more complicated than this, as I'm going to show you. So now when the same values exist side by side in a bullish or bearish trend, we have Tarosochi, right? Hengi is divided into Jiugi and Kikugi. When the values are the same but they overlap each other, this is known as Jiugi, as shown below. Points A to C was 25 bars and points B to D was 26 bars. But points B and D overlap points A and C. This is Juigi. All right, so points A, C was 25 bars. Okay, so on Hinka B, so we had a high and a low. From that high to this low was 26 bars, A to C. From B to D was 26 bars. From this low to this high, same period. All right, so, but they overlapped each other. All right, previously I showed you they were right next to each other. This time they overlapped each other. Therefore, this is Jiugi, all right, when they overlap. So now below you can see two values of 33 and 32 bars, which are both Kiansuchi. From points A to B equals 33 bars, and points C to D equal 32 bars. But between points B and C, we have a gap, shown with this blue box. This equal numerical value with a gap is known as kakugi. All right, before they overlapped, now they have a gap. Previously they overlapped, now they have a gap. So you got three different ways: when they're combined right next to each other, when they overlap, or when they have a gap. Okay, in this case they have a gap known as kakugi. And you know what, guys, this is getting extensive as far as the values. Basically we're going to make it a little easier when we start looking at the charts. And now we're going to be where the time theory supports the wave theory. The time and wave work in combination with each other. The most basic idea of Ichimoku Kinko Hyo is time relative to the basic three-wave movement. That is the completion of the three waves in equal numerical value, and it has a great influence on the direction of the market, and I'm about to show you that. This is an I wave, a 26 period I wave. This is an I wave, a 26 period bullish I wave. This 26 period I wave could equal this next 26 period I wave. All right. Or this 26 period I wave could equal a 26 period V wave. Or this 26 period I wave could equal a 26 period N wave. You'll catch on in a little bit. Now we have a V wave. This 31 period V wave. Now look again. 31 is not one of our numbers. When I'm talking equal numerical values, it might not even really, it doesn't even matter if it's an Ichimoku number. I mean, you want it to be an Ichimoku number, but sometimes it's not going to be an Ichimoku number. All right, so it's not going to be Kiansuchi, it's going to be other than. So now, since it's 31 that I put here, equals a 31 period I wave, or this V wave, 31 periods, could also equal a 31 period V wave. So V wave equals V wave. Our V wave 31 periods equals N wave 31 periods. And then finally you have an N wave. So you have the three wave structures, one wave, two wave, and then the complete three wave structure. Now I don't have anything listed down here. So let's suppose we put this at 33. All right. If this is a 33 period N wave, it took 33 days to make this N wave. It could equal to a 33 day I wave, or it could equal to a 33 period V wave, or it could equal to a 33 period N wave. All right, and there's a lot we'll know about the market if it equals a 33 period N wave, I wave, or V wave. If a 33 period I wave develops after a 33 period N wave, the market has slowed down considerably. All right, and you know that it's getting weaker. Okay, so that's one thing that would help you to understand the market. Let's look at the same things but a little bit different. Now you're going to be able to see this. All right, so AB is equal in time to BD. AB equals BD. All this is a I wave equals a V wave. All right. And the same holds true in a bear market where this I wave equals this V wave. So AB equals BD. I wave equals V wave. We've already talked about this. I'm just showing you in a different way. And here we have AB is equal to CD, which means AB is an I wave equal to CD is an I wave. I wave equals I wave. And in a dropping market, I wave equals I wave. AB equals CD. And then here we have AC equals CD. A to C is a V wave. And C to D is an I wave. V wave equals I wave. In a bearish market, V wave equals I wave. You're going to be searching for these to give you clues to the market. Now, this isn't going to be a lot of what we're going to add on to the three-row reversal and improvement trade today, because too much of this for you. I'm going to make it a little bit simpler. All right, guys, so now I want to show you how to incorporate basically the price observation theory, shooting for the target. I want to show you how to incorporate that into the three-row reversal trade. So again, we have a three-row reversal trade right here with a TK crossover. This one is a bearish crossover. And then we get number 2. Chiku span breaks below price. All right. So we have 1 and 2. And then we get 3. All right. So we got them in the order we want, 1, 2, and 3. and then we're going to enter short. When we enter short here, we need to know where our targets are. All right. So we need to understand the direction of the market. We need to understand everything that's going on with the market. So we're going to look at this N wave. So what we have here is A, B, C. You have an N wave. We also understand that the market failed to break this high here and made a new lower high, which was a new bear fractal, a new bull fractal. All right, so this bull fractal was the highest, then we made another one lower. I now know I have a V wave, so I'm going to be looking for the completion of the N wave. And even entering this trade, I know I have an N wave, and I know I may be close to that N wave target. So what I'm going to do now to find my trade, we're going to go backwards and think about. Let's go back really quick and look at what I told you about those levels. All right, so let's go back. We are now going to be looking for these levels. E target, because now we're getting into that trade at the C level. Pretty much the trade now is past the C level, and we broke out of the cloud. Say we broke out of the cloud here, right? If we're breaking out of the cloud here, we want to know where our target levels are. So we're going to shoot for E target, V target, N target, and NT target. And now I'm going to show you that on a chart. So let's go back to where we were. Got to go back to help you to remember what we're shooting for here. So let's go back. All right, so now we're back where we want to be, and now we need to find those targets: N level, V level, E level, and NT level. The way you find those is A, B, and C, and the way I showed you how to do that previously. I already know what these levels are and marked them down, so I'm going to show you. Here are those levels. This is the NT level, all right? This is the N level. This is the V level, and this is the E level. So now you know these levels. Now you shoot for these targets. Now the problem for me entering this trade short, we've just bounced on the N level. We made a full 1-to-1 ratio N wave, all right? So that would be kind of scary for me, because I would be thinking that the market may retrace pretty well, all right, because we bounced off of a 1-to-1 ratio. And the market likes to see these 1-to-1 ratio N waves. But the market continues lower and finds support at the V level. All right, so now I'm probably thinking maybe I want to take my profit. But these could be profit targets, and you don't have to take all your profit. You can take some of your profit and let some run. Then the market violates this V level right here and drops all the way down to the E level, retraces and drops back again. All right, so you can see how these levels play an important role with the market. And then finally the market violates this level. But then it retraces all the way back up. And look where it goes right back up to. The V level hits right on it. And which lines up pretty close to your Kijinsen. And at that point, the market drops, goes farther down. And then finally, the market closes on the other side of Kijinsen. At that point, we could take profit. All right, so we can get out of the trade, be done with the trade, take profit. We made 373 pips profit. That's all you want to do there. All right, so you understand and see that you can make profit by closing on the other side of Kijinsen, and also using your profit target levels to help you to understand where the market may go. Now, in this case, the market blew through those levels. It's paused at each level pretty much, but it still continued to the downside. All right. All right, guys, so let's go to the charts and show you some of these in play. All right, guys, so we're going to watch the market. We're going to just follow the market and look for the breakout and take those breakout opportunities based off of the 3-row reversal and improvement signs. So let's just follow the market and watch to see what we get here. All right. The market's continuing to move higher. Now we did get a crossover right here. So we got a crossover. we got this bearish crossover, and the market failed to violate this upper level, and it looks like we're starting to make lower bull fractals. All right, so we failed to violate this point, so it's a good sign maybe that the market may be finding a top. And then now number 2 has happened, where Chiku span closed below this price level here. All right. All right, so now we're kind of sideways, and I wouldn't consider that closing outside of the cloud. Now we did. I would take that trade right there. All right, I wouldn't consider this one, but I would take this trade now right here. So now knowing that, guys, there's a couple things about the chart that I can understand. So first of all, when I look at the chart, I see 1, 2, 3, and then I'm shooting for 4. I have A, B, C. I would be shooting for 4, so I need to know these target levels. All right, so what I'm going to do is calculate those levels and put them on my chart, and then we're going to shoot for those target levels. Okay, let me put those on my chart. All right, guys, so now you can see those levels on the chart. So basically you see the NT level, and then you see your N level, your V level, and your E level over here. So these lines here. So now when I get into a trade, once I take this trade, so now what we saw was the market failed to break this high here. We also saw that the market now formed this new N wave to the downside. So if you have an N wave, a bearish N wave, the market's bearish. If you have an N wave, that's going to the downside. So when I look at the 1, 2, 3 formation, or basically like the 1, 2, 3 formation, when I tell students to look at that, your 1, 2, 3 formation is going to continue to the downside, and then it's going to pause with a low, and then you're going to see a 1, 2, 3 reversal, where you have a 1, 2, 3 to the upside, which is a new N wave to the upside. In this case, that we had fluctuation here, and then the N wave to the downside developed. All right, so the market formed this new V wave here. So you have a V wave right here, points A, B, C. I'm shooting for D, and let's see where the market goes. Automatically goes right to the N level. All right, the 1-to-1 ratio level. So I'll show you on the chart basically what that looks like. Well, you could see if you add these pips up, it's going to be the same as this point. Okay, the exact same right there, because it's smack dab on the N level. So that's a sign that I could take some profit there. I like to let the market go, see what it's going to do. Looks like it's trying to hold there. Then it drops lower, closer to the V level. All right, so closer at that V level, and then sits on the V level. We got distance on Kijinsen, so we're out of equilibrium, but we're still dropping. Always trade the direction of Kijinsen. Never go opposite of Kijinsen. So if Kijinsen's pointing down, even if it's flat, you could take your downward trade if it was already pointing down. All right, so if it was pointing down, then it's flat, you could still trade short. But if it was pointing up and you're going short, you're totally wrong with your Ichimoku, totally. And then now we're flat, but we continue to go lower. Still have angulation, which is a good thing. And we're correcting back to these levels pretty much. And then we're going to the next level. We correct back to the E level, to the V level, and drop smack to the E level. Smack to the N level, smack to the E level. You can't make this any better than this. And then now the market's between those levels. Rejects off of the V level. And at this point, we're closed above Kijinsen. So you had an opportunity to get profit here, here, and all the way down here for sure. And then the market moved higher. You could see this level held true. Okay, so basically that's how you're going to use these. You're going to pretty much use these levels as profit target levels. All right, so let me show you again. Let me show you another chart. Let's look at it again. All right, guys, so we're looking at another chart here. We're looking at the pound CAD. Let's follow this one, see what we get here. So we got a crossover, the first thing we want to see. But guess what? When we had the crossover, we also had Chiku span fall below the candle line. All right, so it fell below the price line. So it just is below the price line, and we just had the crossover. They both happen pretty much at the same time, and that's okay. All right, long as you don't get the Kumo breakout prior to those two things happening. So now we already have rule number 1 and 2. And now we need to see and wait for a breakout of the cloud. I wouldn't consider this a breakout. It was close, but this is definitely a breakout. And you could have considered this a breakout because it was outside of the cloud at this point. You could see it closed down here outside of the cloud. So really you could have got into at this point. Now what I'm going to do is I'm going to look at this market because the new N wave structure has developed. All right. So what happened here, you had the 1, 2, 3, 4, then you had 1, 2, and we broke past 2, past the 1 level. So we know that we don't have that structure anymore. The structure has changed. Now we're going to look at the new structure. All right, so 1, 2, 3, and then shooting for 4. So 1, 2, 3, 4. A, B, C, D. We're shooting for those targets again. So let's put those targets on our chart and then see what the market does. All right. So now we have those levels on our charts. And when we're looking at this chart, to me, it's like I'm almost at the end level. I might not take this trade. But the thing about it, if I had taken it up here, I probably would feel more comfortable taking the trade. But I'm way down here, so I may think about, well, maybe I'm not going to take that trade. What I now look for is that S-wave pattern. So if I'm going to look for that S-wave pattern, I'm going to be looking for this trade. I'm going to show you right now. This is the biggest trade that I trade. Now, we'll see if it develops, but we're going to follow the market through. So we talked about the S wave. All right, so in order for this to be an S wave, the market would have to put in this. So it's done this, and then this, and then it would have to do this, come back up into this point. All right, and then that's where I would get into my trade. That's the way I trade these S waves. All right, so that's what I would be looking for at this point. I probably don't take this trade because I'm too close to the 1-to-1 ratio, and I don't want to. That's a good sign for me, basically, when looking at Ichimoku and I'm using these observation theory levels. I know I'm close to an area where the market may pull back. But let's just continue on with this. I'll show you how to trade the S wave another day, but let's continue with this. So we'll take these off the chart. And then now, let's see what the market does. Now, had I gone with that trade, it dropped a little bit lower. And then it dropped. Look where it hit, smack on the E level. So every time so far we've come down and we've hit this E level. So this is a good thing for us to know that the market reached this E level. A lot of times we won't see it go past that level, but sometimes it does. A lot of times you see it retrace really big before it goes past that level. So my S wave was not able to get into the trade. But again, a new S wave developed. All right. But again, we were close to this level. Now, when I look at that new S wave, let me show you it again. So a new S wave developed pretty much like an N wave, but when you look at this, if you watch this market structure closely, you're able to get that trade right there, and you would have been short right there. Okay. But you also got to think about the market and where it's going, how it's moving, how far has it moved, things like that. And this is where you start using your time analysis and everything else. Now see, my S wave trade would have been pretty good. I would have made some profit. But continuing with this breakout trade, basically the 3-row reversal, we're making profit. And we could have taken all of our profit here. All right. But now we're going to let this market go, because now we're going to get out right there on a close above Kijinsen pretty much. So we lost some profit waiting for Kijinsen because we came all the way down to our level, and then we weren't not able to get out of the trade until after Kijinsen. So we lost some profit. But that's a good trade. But that's basically how you're going to trade this. So there are some opportunities in the market right now that I want to show you for you to be able to catch some of these opportunities maybe the next couple days or so. So let's look at those real quick, and then I'll get out of here. So looking at the euro pound, it looks like we've got a TK crossover right here that's bearish. And we got Chiku span under the price. And now price is inside this cloud. With a breakout of the cloud, that will be a 3-row reversal trade opportunity. So you want to keep an eye on this. You can see the N wave structure has failed to the upside, because this would have been your N wave. So let's draw it out. This would have been your N wave. 1, 2, 3, and then 4. But we didn't get past this level. So this level, we failed right here. Failed to break higher, and we made a lower high. So then now the market says 1, 2, 3, shooting for 4. So when we break out of that cloud, we'll be shooting for 4, because we have A, B, C, and then D. So we would want to know where those D levels are. And you could get those levels right now and put them into your chart. So matter of fact, what I'll do, I'll put them on there for you, and you could see where they are. So you can mark them on your charts, because we're going to have an opportunity for the euro pound if it breaks through the cloud. So I'll put these levels on for you right now, and I'll show you what those levels are. So let's put them on the chart. All right, guys, so here's your levels that you're going to be shooting for if you do get into a trade. So the scary thing is that a breakout could be right near the end level, which probably might see a 1-to-1 ratio and a pullback. So it might not be such a great trade, but we can still wait and see, because a lot of times we saw that the market got down to this E level, which is way down here at 0.87007. Your V level is at 0.87281. Your N level is at 0.89107. And then your NT level, you already passed that point. But these are the targets that you would shoot for, these 3 main targets here now. So watching the market go to the downside, that's what you would look for. And then also, if you break these levels, look for the market to break these levels, come back to these levels. You could trade short on these levels again as resistance points. All right. So look for that. That's going to help you for that trade. And that's going to be the euro pound. All right. Let's go to the next one. All right, guys. So the next opportunity is going to be this pound New Zealand dollar. As you could see, getting ready to break out of cloud, could break out of this cloud tomorrow if it's going to continue to move to the upside. Now, the thing about it is, I believe we have a new formation of the M wave, because look what happened here. This was the low, but then we did make a new low. And then the next thing was we have a new low, a higher bear fractal. So this low here was taken to a new low, which was higher with this fractal here. All right. So now we have 1, 2, 3, and then we would shoot for 4. So the pullback, I'm going to actually mark it from this point. I'm not going to mark from here. I'm going to mark from this point, not this candle, because we were here and then we dropped to this point. So let's see where the levels are that we're going to be shooting for with this chart. And then I'm going to show you, and then that's where you could look for your targets with these trades. All right, so if we look at this pound New Zealand dollar for a breakout opportunity, you're going to see that the NT level. I think this level, yeah, this level, let me figure this out here because, all right, I see here. Yep, this NT level is not usually longer than the V level, but that's a small correction. The V level is going to be measured from, all right, so when we take that V level, we're only going from this point to this point. So let me check this out. So you could see where that V level is. I just measured it 201 pips basically from this point to here, and then you add it on top of B. Gives me that V level. So that's going to be where we're going to be shooting that first target we shoot for. The NT level usually is not farther away than the V level, but since the pullback was short, you had this all this leg to measure. So from here to here, you're measuring your NT level, and let me show you. So basically from this point down to this point, which was roughly 604 pips, then you're going to add it on to that point, and that's going to give you that NT level. And you can see we're right there at the NT level, right? So you got that NT level, and then your N level is going to be basically adding this leg from down here to the top part, which would be your B level. Add that on, and now add it on top. Actually, that's going to be your E level, sorry. That'll be your E level, and then your N level is going to be that same leg, so this leg. And it should be right there. And then we're going to measure it from the bottom of C, right there. And that gives you that N level. All right, so those are your levels that you're going to be shooting for in these trades. So basically, when this breaks out of the cloud, your first level is the V level, which is very close at 2.004. NT level will be at 2.01980. The N level is going to be at 2.03998. And then your E level is going to be at 2.06015. All right, so let's look at one last trade opportunity I think there is on the charts. All right, guys, so this time we're looking at the New Zealand dollar Swiss franc, and we're getting ready to have a breakout pretty soon. You got your crossover, you got sequence span below price, and you even have a future that's dark. So a breakout here will be very strong signal. Actually, you have all signals of Ichimoku bearish at that point. So you get this breakout, could happen tomorrow. We want to see our target levels. So let's find these levels, because we're going to go A, B, C, well, basically up here, and then D. That'll be our targets. So I'm going to put those levels on the chart for you one more time, and that's going to be the levels you're going to be looking for in your trade. But also remember, you don't have to take all your profit at that level. What you need to look at is if the market's really trending nice, you can follow Kijinsen down. And as Kijinsen breaks those levels and gets through those levels, now you're going to use Kijinsen as your stop loss, as like a trailing stop loss. So let me put those levels on the chart for you, and then we'll talk about those levels, and then looking at the breakout trade. You got all signals. All you need is a close below the cloud right now. All right. So let's put the levels on. All right, guys. So I magically put these numbers on your chart, these levels on your chart, so you could see where you need to be shooting for when you get this Kumo breakout. So if you get this breakout here, you're going to be shooting for the first level, which is going to be this N level at 0.59639. The next level will be this V level at 0.58558, and then finally this E level at 0.57840. Now also remember, use your Kijinsen as your trailing stop. You have all signals Ichimoku bearish now, except waiting for price to break outside of the cloud. So this could be a very good opportunity for you for a good trade. Now be careful, we do need to get through this N level. You may bounce off of N and retrace, and then may be able to get back into the trade again. Maybe by that time, if you think about the trade that I talk about for your S wave, you'll be able to think about that kind of a trade. But since you don't really understand that trade, don't try to just gamble on that and take that, because I'll explain it even deeper for you to understand more. But guys, I got a couple courses. show you how to trade this Ichimoku to the max using basically fractals, price action, and the Ichimoku theories. So if you want to learn more and understand more, become a member of my site. Right now it's a lifetime membership, so one flat payment, you're a member for life. You get all access to every single thing that I have all the time, anytime. All right, so that's going to be the end of this. Hopefully this helped you guys out, and guys, till next time, have a great one. God bless.